Good morning, everyone, and good afternoon to those people on the East Coast. I'm Lorraine McGregor, and I'm here with James Ferguson, and we are going to show you how to sell your business or help you evaluate should you or should you not sell your business, and of course, how to succeed. We'll be taking questions at the end of the webinar at around noon. So as you listen and you have questions, type them in the question box, and we'll take all the questions at the end of the presentation. Okay, let's dive in. So I wanted to introduce my guest today, James James Ferguson. Sorry, I have a client name first. I'm so sorry. James is with RBC Wealth Management, and he's a private banker and a chartered accountant and a financial planner and a heck of a great guy. And I always wanted to understand really what a private banker is. And I finally asked him the question this morning.
So I'm akin to a general practitioner in the financial world. So I have a broad scope of knowledge. It's deep in certain areas, but I know that there are certain areas where I need to bring in experts. So my role is to understand the client's past, their present circumstances, what they're trying to achieve, and then know where I can help them and where we need to bring in experts.
I like that analogy of a private banker being a doctor, a GP.
Yeah, doctor in the financial world.
Yes, okay. And the reason that I brought James on to help us today is to help business owners and advisors understand what their financial position will be at that point in time when they don't want to be running their business anymore. And I think that's a key decision driver that many business owners maybe aren't aware of. And so that's what we're going to focus on today. I'm Lorraine McGregor. I'm a partner in Spirit West Management, which I co-own with my husband and co-author Rob McGregor. And we help businesses grow to the next level. We help them become saleable, and we're also quite well known in the mergers and acquisitions world. We've spent a lot of time in the Association for Corporate Growth learning how buyers think about how they're going to acquire companies and why they select only 2 or 3 to buy after searching through hundreds. So why don't we start the process? So how many I'm going to run a poll right now to find out who we've got in our audience. So, are you a business owner or are you an advisor to business owner? Maybe you can answer the poll for us. We'll just take a couple of seconds here. We've got business owners, and so far it looks like a 50-50 split. Thank you for letting us know that. Super. So we'll be addressing the needs of business owners and the advisors who have clients of business owners. Okay. So as we've been developing our mentoring programs and our books and helped business owners become saleable, we often ask the kind of question that they've never been asked before, which is, do you want a return on your investment in your business? And of course, yeah, that's an easy answer. Yeah, I think I want an ROI. And then we ask, do you know how to do that? Well, a lot think they know how, but they don't know when they're going to sell. And maybe it'll be 5 years from now. And a lot of owners believe that because they have successful companies, they should have no problem selling. However, what we've discovered is that many businesses are having problems selling. So let's look at another poll and get your opinion about this. What do you think? Do you know a business? Do you or your business owner clients think that they'll be able to sell or even want a return on their investment one day? Let's see what the poll says. And it looks like the winning answer is going to be yes, and I sure hope so. Oh, and no, we've got some no's. Oh, look at that.
Interesting.
Yeah, very interesting. No, they're not even counting on getting a return on their investment. Well, we want to show you how to get a return on your investment. So I'm going to close the poll. And because we've done so much work with buyers and M&A professionals, we understand how valuable your company is to getting a secure financial future and how it becomes especially attractive to business owners, or pardon me, to buyers. So we love this euphemism that Warren Buffett uses. When he explains investing, he says, well, buy low, sell high. And oops, we've got a beeper thing going off here. Thanks, Jamie. Buy low, sell high, and only invest in things you understand. Well, great advice. Of course, you understand your business. And if you think of it like an asset, you bought in low and you very well could sell high if you make the preparation and that we're going to show you today. And the details, of course, make all the difference in the world. So when is the right time? Well, when you decide you want a different future than the one you're heading for now, and then make some informed choices about the legacy you want to leave for all the stakeholders in your business, like your customers, your employees, and your family, what you're going to do for your next act, and the value that you want to sell it for. And then what you've got to do is commit to make the company worth what you want to sell it for with a saleability blueprint. And we'll explain to you what a saleability blueprint is as we go through this event. So there's 3 steps to making the right decision. Think of your business as an asset, just like you'd buy shares in Apple. When you know the facts about what it takes to get a return on your investment in your business, it's easy to make a good decision. So, for instance, if you bought Apple at $208, like I did in 2010, then the right decision for me would have said, well, I want, 100% return on my money. So when Apple gets to $416, I should sell it. If I had made that decision, then when it shot past $700 in September of 2012, I would have sold. But I didn't, because I didn't make those choices. And today what is it at? $539, but it dropped all the way to $421. And who knows if it's ever going to get back up there. Yes, I've made a return on my investment if I sell it. And of course, that's the key to turning your business into an asset that's saleable, along with knowing your options so that you can choose the kind of financial future that you want. Now, with most companies, you either close it one day or you make it saleable. You've got 2 forks that you can take there. And to make those decisions long before your exit date is how you're going to get that return on your investment. And how do you get there? By building a saleability blueprint. And then you implement the plan that will make your business what your ideal acquirer is looking for. Okay, so I want to tell you a story. Here's what happens when our clients apply the steps that we're about to share with you. They start with a valuation goal. We had one client that, I think there was 7 shareholders. They all had different numbers that they wanted to be able to sell the business for, but they definitely wanted a way out. And they had some people wanting to sell at 12 million, some people not wanting to take such a low number. They wanted 17 million, and there was a lot of dissension in the ranks, but we finally formed an idea around getting a valuation of 17 million. What did they have to do to get there? They had to find a way to get consistent profitability. And that way, if the business became easier to manage because they could predict when they'd be able to pay a bonus, when they could hire, when they could grow, how they could invest in the business moving forward. And that kind of financial certainty created unity amongst the owners, the partners in the business, so that they started to have hope. Because when we first met them, they didn't have hope. They had just spent $1 million on consultants trying to find an exit strategy, and they were nowhere closer to getting that exit. All they did was argue about how to get it. And while Grant Thornton gave them a valuation of $7 million on paper, they actually were unsaleable. And they could never predict when they could pay bonuses. And the year that they didn't pay bonuses, they started to have an attrition problem. Their employees started to leave. So, out of the hope that we helped them create by them following our steps, they got an offer. And if you stick around to the end of the webinar, I'll tell you about the kind of offer that they got and what it did for them and what kind of financial freedom they have as a result. So here's why we're concerned and why we're running webinars, why we're writing books, why we're inviting people like Jamie along to talk to you. Here are the facts based on our research. There are 3.6 million business owners in North America that are boomer aged. I forgot that part. And in 2005, Canadian Federation of Independent Business surveyed business owners and said, how many of you want to sell? And when do you want to sell? And they said in 5 years. In 2007, PwC repeated the survey and got a very similar answer. So as we spent time with buyers and we're learning all about the fact that they do only pick 2 or 3 deals out of every 200 to 900 businesses they look at, we thought, how many of those businesses actually got the exit that they said they wanted back in 2007? So we went to our contacts at Capital IQ. Those are the people that track the number of businesses that sell. And we said, how many have actually exited in the last 5 years? And we said under 500 million. And they told us 199,406. Well, I don't know about you, but that was a shocking number to us. And we said, what are all these people doing that said, they were going to sell in 5 years and they didn't, and did the economy turn off that many people? People age, businesses decline, circumstances happen. What happened to all the people that actually decided they were going to sell? Well, we dug a little further and we talked to our investment banker friends and our business broker friends, and they told us that 1.7 million attempted to sell and failed.
Wow, that's a really shocking number, isn't it? Why was there a common theme behind all those failures, or what was it? Were they asking for too much, or there was just absolutely no offer on the table?
Well, this is what we learned, that from business brokers, from investment bankers, from the buyers themselves, that business owners come to the exit decision because of circumstances, so they haven't made their business of interest to a buyer. They're not prepared in a way that would make the business transferable. So that's the first one. And of course, when they're not transferable, a business broker or an M&A advisor is not going to take them on as a client. So they don't even get representation. The ones that do get representation haven't done the work inside their business that makes the risks will go away for a buyer. And then the third reason they told us is that business owners haven't emotionally let go to be able to sign on the dotted line once the letter of intent is put in front of them. And because they haven't let go emotionally, the value that they place on the business is so often much higher than the value the buyer places on the business. So the deal doesn't go through.
Sort of the price versus value. There's a differentiation between the two terms.
Yes, and I guess that is what we're going to go dive into much more deeply, because of course a successful business should be saleable, but unfortunately a buyer is looking for the elements inside the business that's going to drive their business growth, and if they can't run the business in the same way that the owner has, they're not going to get that growth.
That's interesting.
So let's move on from these dismal statistics and find out how to get into that 10% of owners that are actually making it. This is, by the way, a 90% failure rate. It's pretty sad. So why is that failure rate so high? Why are we seeing assets melt away? Everybody talks about the 10 trillion in wealth that's going to be transferred. Well, if there's a 90% failure rate, let me tell you, those assets are going to shrink and melt away before they ever get transferred, if they ever can get transferred. And that's those are very scary statistics. And I want to plant a big seed of hope because it doesn't have to be this way. So, what makes the difference for the 10% that are getting their ROI? Well, unfortunately, because there are so many business brokers and M&A advisors calling business owners all the time saying, "Let me market your business," owners believe that they should have no problem being able to sell because, of course, it's like being picked for the baseball team. Someone called me and made a deal and offered me an opportunity to sell my business. Hey, when I'm ready, it'll be easy.
That's the story I'm hearing.
And you're hearing that from your advisors too. That's we appreciate the fact that brokers have to market, and this has created a false sense of security amongst business owners. So here's what the ones that are succeeding are doing. They're getting the right information in time to make crucial decisions so they actually make their businesses saleable long before their exit dates.
Why would you want to do it before you want to exit?
Well, for two reasons. One, a saleable business is actually easier to run and more profitable for the owner, and the owner is the primary investor. So why wouldn't you want a better return on your investment now so you can grow and become a lot more effective in the marketplace? And the second reason is that buyers come looking when it fits their strategic needs or their financial thesis, if they're financial buyers, not when the owner is looking to exit. So if the return on the investment goal is more important than when you exit, you get into that 10% owners club.
Okay, that makes sense.
So getting that right information, let's find out what that is. So we like to think of businesses as an asset. So we're going to combine them with all the other asset classes. So you probably have a stock portfolio and you bought things like Apple or mutual funds over the years. You probably have a house and maybe some other real estate sitting in your portfolio. So which asset do you think is going to give you the better return for your investment of time, effort, and cash? We're going to have another poll here. So what kind of ROI should you expect from the sale of your business? And here's the poll. Tell me what you think. So are you expecting a 75% to 100% return on your investment, 50 to 74%, 20% to 49%, 11% to 19%, or less than 10% on all the time and effort you've put in and the money? So let's see what everybody says here. Aha, looks like interesting answers. Okay. A couple more people still need to vote. And I'm going to close the poll in just a minute and find out and reveal to you that 45% of you believe that you should be able to get a 75% to 100% return on the sale of your business. Well, let's find out what the truth is here. So if you invested in stocks, Jamie, what kind of returns are people getting on the stock market these days?
From in our sort of financial projections that we do for our clients, we do them in a conservative manner. So we don't want clients to be running out of assets. So we'd rather project a low rate of return. They can plan based on that. We're using 5 to 6% generally these days.
And how predictable is the stock market at generating that return?
Well, I think everybody would concede that it's fairly volatile. The last 10 years, this past year has been good, but the 10 years prior to that were a little bit rocky.
Just a little rocky. Yes, I totally agree with you. And when we think about, I remember, Jamie, you told me a story about how much of house wealth is wrapped up in people's portfolios. How much is it these days?
Well, in Vancouver, it tends to be quite a high proportion. So I'm not sure that that's In fact, I doubt it's consistent across the continent, but it's not unusual to see half of a person's wealth tied up in real estate in this city.
But if how many of us are going to sell our houses to fund our financial wealth in retirement? Is that what we're counting on?
It seems so, but the problem with the house is that you need to live there, and you can't sell a portion of it. So you need something that's more liquid and more fungible.
Yes. Well, I'm not intending to sell my house. I want to be able to sell my business. So, what kind of return on my business can I expect? Well, we did the research, and for saleable businesses, they can expect a 20 to 40% return. And that's the median. It's not the high or low. And I know 45% of you are hoping for 75% to 100%. But what's the truth? If we think that a saleable business can get 20 to 40%, what are most businesses getting who are not saleable? Well, it's less than 6%. That's staggering to me.
Yeah, it's for all the sweat and toil that goes into running a business, it doesn't seems like there'd be better options.
Yeah, and if you're counting on being able to sell and you are not able to sell, all you've really got for your return on your investment is how well you invested.
The excess cash flow that you have, and what I've seen is that a lot of entrepreneurs are sort of living on on the cash flow that the business can generate, and not necessarily putting enough, taking enough off the table.
Well, we're going to dig into that in a few minutes. Let's find out how we're going to do this. So, to get any return for you, here's the takeaway. And, this is your biggest asset. There has to be perceived economic value from the buyer's perspective. There has to be what we call saleability factors. So, in helping you understand the facts, let's dig into the difference between economic value and subjective value. Now, subjective value is, I'm a business owner. I love my business. I do. That's why I do it. And I have a value that I place on it. And then also that tends to correspond with a number that I want to have for my retirement or to be to my reward for doing all this. So business owners tend to get attached to the subjective value. And unfortunately, what you value about your business and what a potential buyer or lender values could be very different. So to get into that 10% club, what you've got to do is add economic value. And those are the saleability factors that drive the value of your business up and the perceived risk of acquiring your company down. And of course, a buyer basically has a checklist. They go through their checklist looking for risk points about whether they're even going to look at your business more. And the more risk points there are, the lower the multiple they're willing to pay, or to the point where they're going to pass and move on to the next deal that will meet their risk profile. So understanding how buyers think is an important part of getting your business saleable, so that you learn how to add the economic value that makes buyers go, oh, I want that business out of all the other ones that they're looking for. So we're going to start to dig into how a buyer comes to their valuation number, so that you start to let go of your own subjective value and start to understand how you're going to get the valuation you really want. So just like we have in real estate, where a real estate agent will look at all the sales of houses in your neighborhood that are similar to yours and come up with a price, the buyers look to a multiple of other businesses that have sold in your industry. And that's one part of the equation. The second part of the equation is your EBITDA. That's your earnings before interest, tax, depreciation, and amortization. So of companies that have sold in your industry at a certain level, they multiply that by your EBITDA, and that simplified gives a valuation. And when you 2 to 4 years before you make your business, before you go to your exit date, if you add economic value to your multiple and economic value to your EBITDA, you're going to increase your valuation and reduce all the risk points that buyers walk away from. So let's go into this in more detail. So I'm going to start here on the left at the purple bar. So your enterprise value goes up the higher your multiple. And we start with a baseline multiple, which we're going to show you in a few minutes. So remember, I asked you to have your last 2 years financial statements. So you're going to have those ready, and you're going to learn what your baseline value is, your baseline multiple. So at a baseline level, you've got you're profitable, you've got stable earnings, you achieve strategic goals, you clean up agreements. Those are the basic things that start to make the business saleable. And for everything that you start to add in, it builds the multiple moving over to the right. And we talk about these first steps as being the time when you stabilize the business, and then adding these next areas grows the business. And of course, the more you stabilize and grow, the greater the value to the buyer. So moving on to the next bar to the right, the financial reporting and key performance indicators that prove to buyers that you can actually achieve what you set out to do. You built a strategic plan, your team executed on it. Here are the metrics that prove that you actually achieved that. They also look for diversified revenue, meaning no more than 20% of your revenue is coming from any one client, and that you've got the types of systems that embed knowledge in the company rather than live in people's heads. And as we add more value, if you've got an innovative product and a broad distribution system, where you've got capable distributors, you've got efficient use of capital, you've got a very capable management team that the owner is not on, then that adds more value. Some of the things that achieve a premium investment are when you become a go-to company, you've got a unique set of abilities that your clients love. And they come to you over all the other competitors because you've solved the problems, the hassles that other businesses can't. And then you've got good working capital, good relationships with the bank like RBC, and a broad customer base. And what really puts the cherry on top of the cake and makes you the best pick out of all the other businesses is a clear pipeline for growth. You might have cross-selling opportunities, intellectual property, some kind of distinct competitive advantage, probably in how your people work and the way you hire your people. And there's a new market that a buyer can get into that they can't access any other way than by acquiring your business.
I think you made an interesting point there, and I thought it maybe highlight it. It's that not only are buyers going to be attracted to this, but so is your banker, and your banking relationship will just be that much easier to manage as well.
Which is really important because when you go into growth phase, you probably need a better line of credit and better financial terms.
That's right. Yeah.
So we call all these elements green lights. Those are those green circles there. Those are the things that you want to add to your business. Now, what makes buyers run in the other direction? Let's look at this. Again, here's your enterprise value, what you think it's worth. And a buyer on first meeting thinks, yeah, this looks like a good business. And the value to the buyer shrinks the more red flags they see. And you know, as I talk to buyers, their full-time job, even strategic buyers like other companies, they have a whole department that just goes searches for companies day in, day out. And they just know what to look for, probably like you do in your business. You know what things are going to cause problems. Well, so do they. And the minute they start seeing them, they are dropping the value, the multiple that they are willing to pay, and to the point where they're not interested in the deal anymore. And it starts with, the memorandum that goes out describing your business. So it looks really cool in the beginning. Here we are on the left. Now we're moving to the right. And they ask questions of your broker. And if they can't get the answers that they're looking for about how the company makes and loses money, they start to have doubt. And doubt makes them ask even more questions to try and uncover how come the business is the way it is. And they look for the fact that the owner might still be a vital part of the company, might be playing a functional role, that there isn't really a capable management team that can take over or that has already taken over from the owner, and that the systems can't report back what the business is doing. And so as they dig into further due diligence, they see that there might not be a lot of margin growth year over year, and it's unclear which products drive growth. And there doesn't seem to be the kind of market leadership that would allow the buyer to get the leverage they want for their strategic goals. And that's when they say goodbye. So this is what's happening to 90% of businesses out there right now. And this is a problem that can be fixed with this kind of information. Once you know about what to do, it's simple. You make a plan, your salability blueprint, and away you go, and you start to build value. So a lot of people ask me how I discovered how buyers make their moves. Well, when I wanted to help our clients make their businesses saleable back in 2000, we were growing them to the next level. And they wanted to know how to exit. So I decided I better go find out how buyers and M&A professionals and bankers think. So I went and joined the Association for Corporate Growth, and kind of felt like a kitten walking into a sea of dogs. Not that bankers are dogs, but I felt quite intimidated because
They're intimidating.
They are intimidating. I didn't understand their language, and deal makers have a special way of talking about the deal. It's very exciting talking about deals. Those are the companies that they're trading, and they're representing buyers or they're representing sellers. And there's a way of exchanging that information. And I had to spend years learning how to speak to them so that they would answer my questions about how our clients could become what they look for. So while it's funny, it was intimidating. And eventually I did master it. And they made me president of the Vancouver Association for Corporate Growth, the chapter there. And, they're an interesting group of people, and they know what they're looking for. So out of all of that research and the years spent with deal makers, we recognized that business owners have a fork in the road to a decision to make. And it's between having a lifestyle business that will close one day or a wealth generating business that they can sell one day. And it takes 2 to 4 years to make those changes in the company that make it that free of risk, free of red flags, and where those green lights are built in so that they become the buyer's choice.
So that's another reason to prepare well in advance of your planned exit date. You can't flick a switch and sell tomorrow.
No, and unfortunately, that is what's happening. So let's look at the options. So if you choose the wealth generating path, and we know that there's only 10% of those people, you have a successful business, you run the business to build economic value. I can't emphasize that enough. Your focus 100% every day is fixing the red flags, adding the green lights. And you look forward to your next act when you're not in your business anymore, and you're proud of the legacy that you've left. The business still thrives, the employees still have a great place to work, customers still get all the great products and services from your business. You're just not involved in it anymore, or you sit on the board, or maybe you're a mentor to people in your industry, but you've moved on. And the business owner who's following this path makes sure the business is saleable and ready when the ideal buyer is looking. So, your desired exit date or retirement date might be 10 years away, but your business is saleable now because you never know when your ideal buyer is looking. And if you think about it, they look at hundreds of businesses, so your business is already on their radar. I know that's kind of a hard thing to understand, but if they're looking in your industry, they know about you already, and they're looking to see who's going to pop out of the crowd with a saleable enterprise. So you can count on investing the proceeds of your business sale to fund your future. So then contrast that with the lifestyle owner. Excuse me, I'm just going to have a sip of water. And this represents 90% of all businesses out there right now. You have a successful business. It makes money for you. You're really happy with it. There's nothing wrong with that. It works for you. You have to realize, though, that it's going to close one day if it's not made saleable because you haven't made it transferable to someone who can find the same success with what you've built and how you run it for your sense of organization today. So you might enjoy the idea of working in your business far into the future. Absolutely nothing wrong with that. We just want you to make sure that you understand what you're getting into in your future. So in option one, if you own a lifestyle business that's not been made saleable, you can cross your fingers and
hope it sells.
Hope it sells. Yeah. That does happen for some people.
Some people win the lottery too.
Some people win the lottery. Yes. I'm counting on that too. Some people work longer. I've been meeting owners who are 70, 75 years old and still in the leadership of their business.
They may enjoy it, but they've made a choice for that to be a lifestyle business.
Yeah. Yeah. And it's recognizing that that's an informed and intentional choice, not a choice brought on by circumstances that you feel out of control with.
That happens too.
Yeah. Third choice, you can save more of your current salary and dividends so that you have more in the bank account to take care of you in the future. Or, we didn't add the fourth one. Oh no, that is all three options if you're a lifestyle owner. So what we want you to do is learn how to choose the future you really want rather than by default heading to option one, hoping you'll be able to sell your business, but all you've got for certainty is hope.
So what Lorraine and I talked about is what is the actual financial future for these various options. And prior to becoming a private banker at RBC, I was a financial planning specialist, which brought in my background as a chartered accountant and a curiosity about how people plan for their future or don't plan for their future, and how to help them sort of develop a roadmap. And so we looked at a case study that Lorraine had, and looked at a few options that might be in this person's future. So we looked at first at what happens if he continues on his current path, spending much of the cash flow that the business generates after paying his taxes, and he's sort of making a gamble that he's going to be able to sell it someday. Then we looked at, well, what if you often get, well, I'll just work longer, as a response to people who are in a bit of a stage of inertia, so that they're not really they're a bit paralyzed and don't know what to do to make their business saleable, but they always fall back on the fact that they could work longer, although that might cause other problems if their spouse is waiting at home, waiting to go do all that traveling that they've been talking about for years. And the third option is what if they actually look ahead. Maybe they can't see a path to make their business saleable. They're enjoying working in it, but it's not going to be able to generate sufficient. They're not saving enough to sustain their lifestyle post exit. So they're going to have to start putting away more money now so that they can fund their retirement lifestyle. And the fourth choice is what if they actually are able to make the business saleable? They sit down, they do the hard work, and what do you know? Success at the end of the tunnel.
Okay, well, why don't we do another poll here and see which of these four options are of greatest interest to you and your clients. So how many of your clients are betting on selling? How many do you think are going to work longer? Or if you're a business owner, are you interested in reducing your current lifestyle? Or are you interested in that wealth generating lifestyle? And we'll wait a few more minutes. We've got, oh, look at that. I think we've got people going for option 4. Wow, they want, okay, that's
Well,
good. They want
that
the
makes
wealth
sense.
generating lifestyle because you got on this webinar and you're way ahead of the curve. Let me tell you about educating yourself. 91% wealth generating lifestyle.
Excellent.
Excellent. Okay, we're happy. Okay, let's find out what the numbers are telling us.
Yeah. So the first step in preparing a financial plan or a wealth plan is figuring what your goals are, what you want to do post exit. Are you anticipating that you would scale back in retirement, spend less? Do you have something you've been putting off that you want to do? Maybe you want to do another bit, invest in another business. Um, do you just want to, you're happy with your lifestyle? Let's continue on, and hope we can sustain that in the future. Or do you want to start traveling more? I mean, often I've spoken to clients; they've been putting off a lot of the things they've been wanting to do. They have a bucket list; they want to check things off, and that's going to cost money. And so they really are going to need more money in retirement than they're spending now. And the other question is, what are your goals for leaving a legacy? Do you want to provide for family or important causes and be able to leave something at the end of the day for those things? So and your ability to do that post exit really depends on you have a starting point, and that's where you are today. So what assets do you have that will provide cash flow post exit? Do you have a pension? We all have public pensions that we are counting on to one certain extent. In Canada, they're not quite as generous as the promises that have been made in the U.S. But not a lot of business owners have a pension coming from the company. There are tax deferred savings plans such as RSPs and IRAs in the U.S. or 401ks. And then there are people taxable investments, so stock and bond portfolios or investment real estate. And some people are counting on an inheritance a little bit sadly. And a lot of people, what if something happens to you? What if you can't execute on that plan? Do you have insurance that would cover an unfortunate event? So we looked at Rod and Eric as a case study. They each have a holding company, and their holding companies are partners in a contracting company. There's $20 million of revenue. Currently, it's making a margin of 7%, so it's got EBITDA of 1.4 million. They each take a salary from the company and reinvest 40% of their respective shares of the profits. So that leaves them, and we'll look at Eric specifically here. It leaves Eric with about $122,000 in dividend income after in addition to his salary. So he's got annual income of $282,000. He's starting in our case study. He's starting with savings of $520,000, and that we use that number. That is according to Statistics Canada, the median net worth of a self-employed person in Canada. So we've assumed that Stats Canada hasn't imputed any value of the business into that net worth. So it's a little bit of maybe an optimistic assumption, but we'll give Eric the benefit of the doubt here. We've also assumed that he doesn't have any debt, which isn't that common these days. As a savings plan, we're going to assume that Eric is going to put the maximum amounts into his RRSP, so that would be, or tax-free savings account, so that would be the same as the 401k and IRA and Roth IRAs in the US, and that he's spending everything else. So that works out to $14,000 in spending per month. As far as investment returns, we've assumed 6% rate of return. And referring back to my earlier comments, that is sort of at the higher end of the rates that one should be comfortable planning based on. We've assumed a 2.5% inflation rate. Tax rates are British Columbia tax rates, so they'll vary depending on where you are. And we've assumed that he's 55 and he'll exit at age 65. So he's got another 10 years in the business, and then he's going to live to age 90.
So, what's in Eric's future?
So, if he continues on his current path, believing that he can sell the business whenever, he's going to continue spending the $14,000 a month. These are gold coins with a $500 face value each. But he's found out, like 90% of business owners that have tried to sell and failed, that this just isn't the case. So, what's his post-exit spend rate that's sustainable without selling the business, but not having put a lot aside? It's actually $6,800. So he's going to have to cut his lifestyle by 51% in retirement.
Wow.
I'm not going to be really. It's not going to be a good day for me or Eric the day that I have to break that news to him.
And what about an inheritance? What can he expect to leave his kids?
At the end of the day, he's going to have less than $100,000. So not only does he not have a lot to leave his kids or cause that's important to him, he doesn't have a lot of room for error here either.
Whoa, scary. And I can imagine what going from a $14,000 lifestyle to a.
Yeah, it's a little bit like driving a BMW today and having to drive a Toyota Echo in retirement.
Oh, my husband would not like that. I'll tell you right now.
Yeah.
Okay.
Right. So Eric, upon being presented these facts, might say, "Well, I can always work longer." So he continues to spend the $14,000 and stubbornly doesn't prepare his business for sale. And at age 75, he'll still have a 17% reduction in his ability to spend, but he's also probably caused some other troubles in the meantime. For example, his spouse, who's been itching to go traveling, is now not very pleased with him, which, if that boils over, will cause more pain.
And of course, we're not factoring in any health issues that might crop up.
Right. Yeah, we're not as healthy in our 70s as we are in our 60s.
And does he get to leave any money to his kids this time?
About the same, so a little bit less than
$100,000. That'll be a happy family. And what does his life look like?
Well, he's had another 10 years of driving that BMW, but he's going to have to keep it a little bit longer.
2004. Oh, not the brand new model. Okay, what else can he do?
So, if he decides that he is not willing or not able to make his business saleable, he's going to have to cut back now if he wants to have not have to drastically reduce his retirement lifestyle. So by my calculation, he'd have to reduce his spending now immediately by 32% in order to be able to sustain that for the rest to age 90.
Wow.
So he's going to have to put some money in his savings, and he'll have to cut his spending back to $9,500 a month. And post-exit, he'll still have that $9,500 a month, and he'll just be drawing from his piggy bank.
Oh, okay. Well, you pull back now, you have more money to last. That makes sense.
So
you can do it.
That could be comfortable. I mean, he might not be driving a BMW. It's more like a Honda Accord.
But he still doesn't get to leave any money to his kids. He can leave the Honda Accord.
Yeah, there's still not a lot of legacy to be left.
Difficult. Okay.
So the fourth option we looked at is, he grabs the bull by the horns and he decides to make his business saleable. He's got 10 years, and he knows it's going to take 2 to 4 years to do the work that needs to be done. And if he sells earlier, then he'll just have more time for leisure. So again, we have the same income, same spend rate, same saving strategy. He's not putting money aside, but he is building wealth in his business, and he is successful in selling it for $8 million. So his pre-exit lifestyle is he's still maintaining the $14,000 a month. In retirement, he's doing the same. So there's no reduction in lifestyle, and he's going to leave $3 million plus to his family or causes.
$3 million. That's substantial. Okay.
So that's a little bit like driving the BMW and then being able to upgrade to the Porsche.
Nice. So I think Eric, even though he's only a 40% owner in a business, could be looking at making a different choice for
But
himself.
being the 40% owner, he's in a position. He does have some power, and he could, if he's not going to be comfortable in retirement under the terms of the deal, he's maybe not going to cooperate. So that 60% owner has an incentive for him to prepare as well.
Great. All right.
So just as if you're considering whether or not you do have enough put away for your future, um, there's a rule of thumb that you could use for every $1 million you have invested, you can pretty much count on that in a fairly conservative, but not extremely conservative way. In these markets, it can probably generate $40,000 a year. So think about what you have in the bank. Think about how much you need, how much cash flow you need, and make that calculation.
Well, I don't know of many people in Vancouver that could live on $40,000 a year. That's shocking to me that you need $1 million to be able to pay yourself $40,000 a year. $1 million save.
Well, interest rates are negligible these days, and uh, equity markets are more volatile. So you don't want to, necessarily be dipping too deeply into capital. So you want
Wow, intense. So, what is actually going on? Let's recap. Actually, business owners are waiting for circumstances to make their exit decision for them. And that is their comfort zone. That is what people like today. And, all we have to do is speak up to the business owner that thinks betting on that future is what's going to give them the financial future they want. So recognize that by postponing, you get option one by default. And that's why we have the 90% failure rate. So, what is the best option for you? Well, as we said, you got to set your intention 2 to 4 years before you ever want to exit. And let's make it a little bit more realistic for everybody right now. Get out those income statements and look at the one that had the biggest year for you, greatest profitability, and search for the earnings before interest and tax statement at the bottom of the income statement. So once you find that number, we're going to take you through an exercise we call the back of the napkin. And the reason that we want to show you this back of the napkin is to start you thinking about the economic value that you want to be able to sell your business for, rather than the subjective value you want to sell your business for. And it's also to show you the possibilities and eliminate any misconceptions you might have about what it'll take to grow your business so it's saleable. And of course, it's completely possible. Our clients do this all the time, that you will make your business saleable. So the fantastic part about learning the value of your company, which you're about to do in a few minutes, is to show you the opportunity you hold in your hand, because you will be able to change your financial future with this knowledge. And for all you advisors out there, if you're the one that breaks the news to your clients about the state of affairs that they're moving toward, you can be the change event in their lives that gives them the kind of future they really want, not the one they're betting on. So, ready? Let's dive. So, this is an example of the types of multiples paid for US companies in the last few years. And in Canada, apparently we subtract about 3 times off those multiples because they're a much smaller market here. So the reason I'm introducing you to the multiples is to show you the potential of growth you have in your business. But what we're going to do, because most businesses are unsaleable, is to think 3 times. We want to set up a baseline, because what you're really doing is creating a metric. Here's what my company is worth today. And this is how much I want to grow it to. And of course, back of the napkin valuations are never anything you take to your banker. You want to get a proper valuation done by an expert, a certified business valuation person, before you use it publicly. This is for your own benefit to help you understand your opportunity so that you can make a good choice for yourself. So here is the math. Take last year's EBITDA, or the most profitable year, and multiply that by 3. That's your baseline valuation. And now you want to compare that baseline number to the secret number, the one that you'd hoped to sell for. And you might want to take a minute and type in the question box your reaction to seeing this number. How do you feel about the fact that you've just determined what your business is worth today? So just type in the chat box. And I'm seeing a few answers, interesting answers there. Some people are not terribly happy with this. Some are okay. And we're going to move on. Some are not so impressed. Well, I want you to imagine selling your business for 50% or even 100% more than that baseline number. And think about whether that is enough to fund your future financial needs. Because that is actually possible when you make your business saleable. Now you need to know how much economic value you've got to add. So think about what you really want to sell it for, subtract your baseline number, and then commit to closing the gap, the valuation gap between your baseline and your secret number by adding the green lights and fixing the red flags in your business. So let's see how Rod and Eric are actually going to make their businesses saleable. This year, they've got $20 million in revenue, and they're in the contracting business, so it's really hard to predict when revenues are going to go up or down, so it's a bit of a rocky road for them, but they're going to commit to holding revenue steady. They've got a 7% of revenue EBITDA of $101.4 million. That's a bit low for the contracting business for saleable companies. So their baseline multiple, because they're not saleable, is 3 times. And that puts today's value of $4.2 million. But it doesn't mean they have a saleable company just because their value is $4.2 million. So Rod and Eric decide that they want to make the business worth $8 million, and that leaves a valuation gap of $3.8 million. So they go about committing to make the business worth $8 million. And in 2 years, they've steadied the revenue at $20 million. They didn't have to grow it because the types of buyers that buy contracting companies actually don't care as much about the revenue as they do about the EBITDA and about the variance between actual estimates and estimates on their projects. And they increased their multiple by 4 times by reducing that variance and making sure that they had a capable management team in place, able to win projects and manage projects. So they actually got their valuation in that 2-year period, and now they're saleable because they fixed the things inside their business that made it unattractive to buyers. So the third step in the process, and this is what Rod and Eric did, is to build a saleability blueprint. And that's a term we use based on our book, Fast Track Secrets for Making Your Business Saleable. It's the program that we put all our clients through. And the book is like the textbook for how to do it. And the playbook has all the questions in it that you need to answer about your own business so that you know what to change in your business to fix the red flags and add the green lights. And it's a 4-step process. The first step is to make the decision we just took you through. Will you have an exit and make your business wealth generating, or no exit and you're going to make an alternative plan so that you have the financial future that you need to take care of yourself? And that's part of handling reality. There's a whole lot of other things to do, but you have taken the first step in handling your reality by learning your baseline value and learning about your financial future going forward. The next step is to hone your goals and decisions, thinking about the legacy that you want to leave, what you're going to do after you exit, and we call your next act, and then to start thinking about how you're going to stabilize your business. Then you've got to hunt the right acquirer and aim your business to become what they look for. That's the secret. And then finally, that builds your saleability blueprint. Now you're ready to execute on it by helming the transition, making the changes inside your business that makes it worth what you want to sell it for. And then you're ready to call an M&A advisor or business broker, not before. And what we're seeing is that business owners hit with circumstances skip all of those steps and go straight to selling something that is unsaleable. So, what do we have involved in handling reality? Well, you decide to be intentional about your future. And we just told you how to do that. You've got to make that decision and come to terms with your company's current value and the fact it's not maybe worth what you want to sell it for, and explore who you're going to be without your business identity, and learn to see your company just like buyers do so that you start to let go of your subjective value. And get ready for change, because making a company saleable is all about managing the changes inside your business. The next step, honing goals and decisions, are focused on key questions that help build the plan that suits you. Jamie talked about the kind of financial legacy that you want to leave. Well, other aspects of legacy include how you want your employees to be treated by the next buyer, where you want your business to grow to, how you want to take care of your customers. If you're a manufacturer and you have distributors, how are they going to be taken care of? Your supply chain. All of those things are part of legacy. And how much do you really want to sell the company for? Well, there's what you want to sell it for and what a buyer is willing to pay. So you have to resolve the discrepancy there. And what are you going to look forward to? The owners that we work with kind of search high and low. They've been so involved in their business, and they don't know who they want to be in their next lives. And owners who have sold, well, they're doing all that traveling you talked about. And they're also, one guy is an angel investor. Another fellow is learning to speak and be on the speaking circuit and share his wisdom. Other people are taking on positions in their industry association. It's whatever makes your heart sing. And when do you want to exit by? And that, of course, that date is also a factor of when your ideal buyer is looking. And then making that commitment to make the changes inside your business so it's worth what you want to sell it for. So there are all kinds of potential right acquirers, but there are things that you would do inside your business that are very different if you want to sell to employees versus selling to a private equity group or a larger company or your competitor, or if you want to bring in a general manager now because your expertise is not growth and a general manager's is. So, all of your decisions in your saleability blueprint are based on what is your ideal acquirer. And then it's time to implement that blueprint, and you're halfway through the process then. So, reminding you that what you're trying to do is to increase your enterprise value by fixing those red flags, and that will increase the value to the buyer. And once you've done that stabilization work, then what you've got to do is build in those green lights so that you have a firm foundation to become exactly what your ideal buyer is looking for. So these are the success principles about how to build a wealth generating asset. You've got to know the facts. Deal with what works, not what doesn't. And I'll tell you what works is building that saleability blueprint. And then know your options. Choose the future you really want from an informed place and stay intentional about getting it. And build that blueprint and get the advice and implementation support, because it takes a group of key advisors to get you from being a business operator to a builder of economic value. It's not something that you've done before, so get the right advice. And there's not a lot of people that know how to do that, unfortunately. But when you read the books, understand how to do it, and you can exactly have the future you want, because it happened for our client. And I promised to tell you the rest of the story about the company at the beginning of the webinar. They were valued at $7 million. They'd spent $1 million on consultants who thought they could get them an exit strategy. Yet when we met them, they did not have consistent profitability. They had complete disagreement about what to sell it for. And we took them through the 4-step program. And managed to take them from a value of 7 million to an offer of 18 million, remembering their valuation goal was 17. And it happened in 18 months.
That's incredible. What was it that what was the success was just getting everybody moving in the right direction, in the same direction, or what was what sort of broke the logjam in this?
Well, when we explained to them where to find their profitability leaks, because we do this so often, we understand where they live. They live in the same places in most companies. They were flabbergasted, and just having that knowledge allowed them to then go and fix those problems, like in the accounting department, and with the way they tracked utilization, and their lack of forecasting, and the fact they'd never built a strategic plan. And the more education we gave them, the more they were able to see the solution for doing that work.
Okay. Those are all things you'd want to do even if you didn't want to sell, right?
Well, exactly. I mean, here's the it was
The more profitable company.
more profitable, and I'll tell you that the owner of the managing director of this company hated getting up at the Christmas party and saying, I'm sorry guys, you worked really hard this year, but there are no bonuses.
Hmm.
And they couldn't explain to their people that there was a ton of revenue but no money to pay, and that was devastating. And I guess the last piece of that is that there was 7 owners in that company, and all of them are millionaires today.
Wow.
And 4 of them still work in the business because that's what they chose to do as their next act. I mean, one fellow was only 45 years old, and he doesn't have to work, but he wants to, and he still has his.
Nice to have that choice.
Yeah, exactly, and because he wants to show his son what it's like to have a normal, regular life, and then he funds his garage band. Yeah. Okay, so how do you do this? Well, we want to show you how to double the value of your business or your client's business. So the key to this is getting fast track secrets for making your business saleable. The book and the playbook is available for $99.95. And when you help your clients and or yourself evaluate which option works for you, it's pretty simple to go about creating a saleability blueprint. You answer the questions and then you implement it to make it possible to double the value. That our client, actually, it was 2.5 times, 250% more value just from in 18 months. Is quite phenomenal.
Yeah, it's amazing.
So if you buy the Fast Track Secrets before midnight tonight, tomorrow night. Let's make it Wednesday. You will also get a 60-minute call with me, and you can review your financial future or your client's financial future. This is for clients of you, all your advisors, as well as for business owners, and with Jamie. And you'll get access to our Is Your Business Saleable quiz to help you understand the actions that you can take to improve where you're at today. So it's incredible value for $99.95. It's available at spiritwest.com/products. And we are ready to take questions. So I see a question about, let me scroll this down. Okay. Do we offer consulting so that you can get help implementing these plans? Yes, we do. I can talk to you about that on our call. We can provide some light guidance, some medium guidance, or the full meal deal, whatever works for you. And let's see, what other questions do we have here? And I've got one here on annual compound rate or total return. I think it's the total return, not the annual compound rate, that someone asked about the return on investment.
Yeah, for example, in the case study for Eric, he had a compound rate of return of 38% for the 3 years that he was making his business saleable, and then we just assumed a 2% growth rate, or 2.5% growth rate equivalent to inflation after that point, and he sold 7 years later. So he was compounding at 38% for the first 3 years that he was making the business saleable.
Super. Okay. Um, and I'm not seeing any other questions, so I think we're going to wrap it up. If you have more questions, you can write to me at lorrainem@spiritwest.com. And I also will tell you that my assistant, Corey Winter, will email you to set up your bonus calls once we get your contact details after you buy the Fast Track Secrets books. So I wish you saleable businesses for you, your clients, and a happy holiday.
Yeah, happy holidays.
Thank you for listening, and we will be sending out the replay tomorrow so that you can share it with people that you know and love who own businesses. Happy holidays. Take care.